While most countries have different currencies, some smaller economies use larger neighbors' currency. Some examples being Ecuador, El Salvador, and Panama, who use the US dollar as their currency. Sometimes nations share a common currency. A large-scale example of a common currency is the decision by 17 European nations, including some very large economies such as France, Germany, and Italy, to replace their former currencies with the euro. With these exceptions, all other economies to trade internationally require converting from one currency to another. We call the market in which people or firms use one currency to purchase another currency the foreign exchange market, or Forex. The amount traded in foreign exchange markets is breathtaking. A 2019 Bank of International Settlements survey found that $6.2 trillion per day was traded on foreign exchange markets, which makes the foreign exchange market the largest market in the world economy. In contrast, 2020 U.S. real GDP was $21.8 trillion per year. The most trade currencies on foreign exchange markets are US dollar, euro, Japanese yen, British pound, Australian dollar, Swiss franc, Chinese yuan, and New Zealand dollar. In Forex, demand and supply become closely interrelated, because a person or organization who demands one currency must supply another currency and vice versa. To understand this, we need to consider four groups of people or organizations who participate in the market. 1. Companies involved in international trade of goods and service. 2. Tourists visiting other countries. 3. International investors buying ownership or part ownership of a foreign company. 4. International investors making financial investments that do not involve ownership. Companies that trade in Forex know that production costs are measured in the currency where production occurs, but revenues from sales are measured in the currency of the different nation where their sales happened. For example, a Chinese company exporting to America will earn US dollar but will need Chinese yuan to pay the workers, suppliers, and investors who are based in China. In the foreign exchange markets, this firm will be a supplier of US dollars and a demander of Chinese yuan. International tourists will supply their home currency to receive the currency of the country they are visiting. For example, an American tourist who is visiting China will supply US dollars into the foreign exchange market and demand Chinese yuan. We divide financial investments that require exchanging currency into two categories. 1. Foreign direct investment, FDI, refers to purchasing a firm, at least 10%, in another country or starting up a new enterprise in a foreign country. For example, in 2008 the Belgian beer brewing company InBev bought the U.S. beer maker Anheuser-Busch for $52 billion. To make this purchase, InBev would have to supply euros, the currency of Belgium, to the foreign exchange market and demand US dollars. 2. Portfolio investment. This involves a purely financial investment that does not entail any management responsibility. An example would be a U.S. financial investor who purchases UK government bonds, or deposited money in a British bank. To make such investments, the American investor would supply US dollars in the foreign exchange market and demand British pounds. Forex traders often link portfolio investment to expectations about how exchange rates will shift. Look at a U.S. financial investor who is considering purchasing UK-issued bonds. Say that a British pound is currently worth $1.50 in US currency. However, the investor believes that in a month, the British pound will be worth $1.60 in US currency. Thus, this investor would change his investment, say $24,000 for 16,000 British pounds. In a month, if the pound is worth $1.60, then the portfolio investor can trade back to US dollars at the new exchange rate, and have $25,600, a nice $1,600 profit. A portfolio investor who believes that the foreign exchange rate for the pound will work in the opposite direction can also invest accordingly. Say that an investor expects that the pound, now worth $1.50 in US currency, will decline to $1.40. Then, that investor could start off with £20,000 in British currency, convert it to $30,000 in US currency, wait a month, and then convert back to approximately £21,429 in British currency, again making a nice profit. Of course, this kind of investing comes without guarantees, and an investor will suffer losses if the exchange rates do not move as predicted. A portfolio investor trying to benefit from exchange rate movements can drive its demand and supply in foreign exchange markets. Many portfolio investment decisions are not as simple as betting that the currency's value will change in one direction or the other. Instead, they involve companies trying to protect themselves from movements in exchange rates. Imagine you are running a U.S. firm that is exporting to France. You have signed a contract to deliver certain products and will receive 1 million euros a year from now. However, you do not know how much this contract will be worth in US dollars, because the dollar-euro exchange rate can fluctuate in the next year. Let's say you want to know for sure what the contract will be worth, and not take a risk that the euro will be worth less in US dollars than it currently is. You can hedge, which means using a financial transaction to protect yourself against a risk from one of your investments, in this case, currency risk from the contract. Specifically, you can sign a financial contract and pay a fee that guarantees you a certain exchange rate 1 year from now, regardless of what the market exchange rate is at that time. Now, it is possible that the euro will be worth more in dollars a year from now, so your hedging contract will be unnecessary, and you will have paid a fee for nothing. However, if the value of the euro in dollars declines, then you are protected by the hedge. When parties wish to enter financial contracts like hedging, they normally rely on a financial institution or brokerage company to handle the hedging. These companies either take a fee or create a spread in the exchange rate in order to earn money through the service they provide. The foreign exchange market does not involve the ultimate suppliers and demanders of foreign exchange literally seeking each other. Say you decide to leave your home in Mexico and take a trip in the United States. You do not need to find a U.S. citizen who is planning to take a vacation in your home area and arrange a person-to-person currency trade. Instead, the foreign exchange market works through financial institutions, and it operates on several levels. Most people and companies who are exchanging a substantial quantity of currency go to a bank, and most banks provide foreign exchange as a service to customers. These banks, known as dealers, then trade the foreign exchange. This is called the interbank market. In the world economy, roughly 2,000 companies are foreign exchange dealers. The U.S. economy has less than 100 foreign exchange dealers, but the largest 12 or so dealers carry out more than half the total transactions. The foreign exchange market has no central location, but the major dealers keep a close watch on each other at all times. The foreign exchange market is huge not because of the demands of tourists, firms, or even foreign direct investment, but instead because of portfolio investment and the actions of interlocking foreign exchange dealers. International tourism is a very large industry, involving about $1 trillion per year. Global exports are about 23% of global GDP, which is about $18 trillion per year. Foreign direct investment totaled about $1.5 trillion in the end of 2013. These quantities are dwarfed, however, by the $5.3 trillion per day traded in foreign exchange markets. Most transactions in the foreign exchange market are for portfolio investment, relatively short-term movements of financial capital between currencies, and because of the large foreign exchange dealers' actions as they constantly buy and sell with each other. Strengthening and weakening currency. When the prices of most goods and services change, the price rises or falls. For exchange rates, the terminology is different. When the exchange rate for a currency rises, so that the currency exchanges for more of other currencies, we refer to it as appreciating or strengthening. When the exchange rate for a currency falls, so that a currency trades for less of other currencies, we refer to it as depreciating or weakening. Conversely, for a foreign firm selling in the U.S. economy, a stronger dollar is a blessing. Each dollar earned through export sales, when traded back into the exporting firm's home currency, will now buy more home currency than expected before the dollar had strengthened. As a result, the stronger dollar means that the importing firm will earn higher profits than expected. The firm will seek to expand its sales in the U.S. economy, or it may reduce prices, which will also lead to expanded sales. In this way, a stronger U.S. dollar means that consumers will purchase more from foreign producers, expanding the country's level of imports. A stronger dollar injures the prospects of a U.S. financial investor who has already invested money in another country. A U.S. financial investor abroad must first convert U.S. dollars to a foreign currency, invest in a foreign country, and then later convert that foreign currency back to US dollars. If in the meantime the US dollar becomes stronger and the foreign currency becomes weaker, then when the investor converts back to US dollars, the rate of return on that investment will be less than originally expected at the time it was made. However, a stronger US dollar boosts the returns of a foreign investor putting money into a US investment. That foreign investor converts from the home currency to US dollars and seeks a US investment, while later planning to switch back to the home currency. If, in the meantime, the dollar grows stronger, then when the time comes to convert from US dollars back to the foreign currency, the investor will receive more foreign currency than expected at the time the original investment was made.